Hello friends, wish you a very happy new year. Today I will talk about macroeconomy 2019 and outlook 2020. The year 2019 is almost over and investors are looking at the year 2020 with optimism. What will be the new year tidings be? How their investments will fare in terms of returns and capital gains? Will the government provide a further boost by cutting personal income tax rates? There are few unanswered questions in investors' minds. The steps which will be taken by the government will matter the most, as it has the potential to spur investments, kickstart the economy, and boost demand for goods and services. There are expectations that something significant will be announced in the forthcoming budget 2020, which is the little over 1 month away. As always, the main things to look in the budget will be its expenditure on social welfare schemes and spending on infrastructure like roads, railways, housing, etc. Next will be the incentives to certain industries like those focused on exports will also count. As already mentioned in my previous communication, the rationalization of personal rate tax cut will strengthen the common man and it may encourage him to spend more on consumption. Other than these, the government has already announced corporate rate tax cuts to incentivize the industry for more investment and capital formation. Whether this will be fruitful or not remains to be seen. The next important point is GST. One issue that merits a mention is the approach towards the GST that will be taken. Here it is ought to be mentioned that a further downward revision will be welcome. At best, they should be left untouched for now till the recovery has gathered strength. For an upward revision in GST rates or bringing items of everyday consumption in tax bracket has the potential to delay the economic recovery. Let us understand GDP. Most estimates put GDP growth rates in the range of 4.5 to 5% for 2020. Industry will take time to revive as always. Demand picks up after a time lag and the same gets reflected on the output side much later. Also understand the impact of NBFC and banking sector. The liquidity squeeze in NBFC and banking sector has to ease. The RBI has already affected rate cuts to the tune of 135 basis points in recent times. The same has to percolate downwards and full benefits have to be transmitted to the borrowers. Micro, small and medium enterprises, MSME in focus. The MSME sector too needs more attention. During the time of economic slowdown, the government's role becomes the most crucial and important. And thereby, the expenditure that it incurs, even at the cost of fears of rising inflation or fiscal deficit, assumes more significance, and MSME is one of the most critical, important point where government will have to focus on. Economy to be boosted. How economy can be boosted? Economy gets a boost when the consumption increases and then can be done by putting more money in the hands of people, the common man. When demand for goods and services increases, businesses see an opportunity and make capital investment in expanded or new facilities. This leads to employment generation and more demand. This no doubt takes time, but the recovery is likely to be more visible and not just flash in a pan. Overall, three important support will be required: monetary, fiscal, and macro policies in 2020. As for 2019, the year is likely to end on a not so optimistic note. Because though we may not be doing as bad as some other economies during the macroeconomic slowdown, it is a known fact that still we are one of the fastest growing economies in the world in terms of GDP. India is now in the midst of an economic slowdown. As research done by various internal and external data, estimates predict the Indian economy to have grown in the mid-range of 5 to 6% in 2019, down from around 7.5% GDP growth rate achieved in earlier years. IIP, Index of Industrial Production. The Index of Industrial Production is a key indicator, has shown the 8 core sector industries contracted by 5.8% for the month of October 2019. These industries are coal, crude oil, natural gas, refinery products, fertilizers, steel, cement, and electricity generation companies. 40% of the weight of items included in the IIP by these sectors. Automobile sales too are down, with some exception in two-wheelers and tire segment. Aviation and telecom are suffering, so is the real estate and domestic banking sector too. Domestic export growth is showing sign of warning, and there is a deterioration in currency movement against the dollar. Rising consumer prices, mainly vegetables and telecom tariffs, and the rising inflation could worsen the situation. The year 2019 was also affected by prolonged monsoon and floods in many parts of our country. The macroeconomic outlook is more subdued and uncertain currently than in the previous years. I feel the happenings in 2019 will effectively set the tone in 2020. The eyes will immediately be on the budget in February. The government has to lead the charge to revive the economy. Tax rate cuts and helping the sector like telecom, aviation, real estate, and domestic PSU banks are welcome signs. More concrete work needs to be done. Investors, to earn returns on their investments, can look forward to invest in well-diversified blue chips and certain sectors like pharma, IT, banking, FMCG, etc. from a medium-term perspective. Investment in diversified equity mutual fund scheme by investing through systematic investment plan is also a preferred route for those not so conversant with the stock market's nitty-gritties. All said and done, broad recovery in 2020 may just not be round the corner. So, ideally, keep patience, wait for the tide to turn, and keep investing in a calculated and risk mitigating manner with lot of discipline. Disclaimer: this is purely a personal view of mine, not attributing to anyone. Goodbye, see you soon, immediately after the budget.
Hope you have liked this knowledge on investing. You can also buy our book Every Woman Should Invest by Alpa. which is available on Amazon India, the link of which is mentioned below in the description. Please like us, share this video, and do not forget to subscribe to our YouTube channel. Share this video with all your friends and family